We're proud to welcome you to a special series of the Exceptional Advisor podcast. Hi, I'm Bob Powell, your host. Over the next several months, this special series will highlight exceptional advisors in these extraordinary times. We hope this series helps you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences in light of the unique challenges and emerging norms of the current times. Today, my guest is Eben Burr, Managing Director of Toews Asset Management. So, welcome to the podcast, Eben.
Thanks very much for having me. I'm excited to be here.
It's a pleasure to have you. And before we get going, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us a brief overview?
Sure. So my background is a little unusual. Now, mostly what I do is teach and coach behavioral finance, but that has not always been my world. I actually entered into the workforce with a master's degree in industrial design and having gone to architecture school in Paris. So not exactly the traditional route to finance or behavioral finance. However, when I look back at that time, I think about what design and architecture are, and they are the interface between human and system. And especially when thinking about product design, there's allure, there's functionality, there is process, and all of those things come into play with what we're doing now in finance as well as in the behavioral finance work that we do. So I look back on that background and it has really served me well in terms of establishing process and that being a huge focus of what we do and the importance of process in achieving objectives. And I don't use the word goals because it seems like kind of a soft word, like it's a New Year's resolution. Mm-hmm. And objectives seem like something that you are dedicated to achieving and will establish a system to get there. So I think that the training in architecture and design actually set me up well for that. And I sort of migrated into the financial side of things in that world and then found myself in finance and now in the behavioral finance. So it's been a fun trip.
Okay. And the company that you're with now, we're eager to hear a bit about its history and how you all got involved with behavioral finance and started the Behavioral Investing Institute.
Yeah, so I've been with Toews for 11 years now, and we have been around since 1996 running risk management strategies, so downside protection. And the reason that's relevant is because our history of clients coming and going, advisors coming and going is somewhat painful, actually. In 1999, people thought, well, I just want more NASDAQ and I don't need risk management because the market's going to go up forever. It's a new world and it's just going to, be perfect forever. Well, that didn't work out so well. However, we massively outperformed during the dot-com bust. And then the money flooded in the doors in 2003. And then in 2007, what do we need risk management for again? And then, of course, we killed it in 2008 and 9. And again, the money came in the doors again. But we had this dissatisfying experience with that because the people who actually benefited from what we did were very few. They left before we achieved our objectives and performed really well, and then came in after the fact. So it's classic return chasing, but it's very frustrating as a manager who is focused on protecting people to have them run away right before they need you and then come in after you've done it. So we thought, okay, we need to help the advisors that we were working with. And so we started studying behavioral finance, Phil Toews and I. And we went out across the country and held these 5-hour workshops with advisors that were using our products and told them all about behavioral finance. We were so excited about it. And it was not in the mainstream as it is now back then. And it was interesting and people were really into it and loved it and were so appreciative and then went back to doing exactly what they were doing before. So we said, okay, let's, we're solutions-oriented people. We need tools for them. That's what we need. They need tools. So we developed some really cool tools for them. The Investment Owner's Manual, the who, what, why, when, manager review form, all these tools for them to use with their clients and continued to educate them. And then still nothing happened.
Humans.
So yeah, right. I mean, if they were chimps, they would have gotten it, right? but they're pesky humans, and they just went back to doing what they were doing. It's way easier to sell returns. Anyone with a spreadsheet can put together the best portfolio in the world over the last 10 years, right?
Yep.
A piece of paper would do. So then we thought, and then we started working with Dan Cullman. He joined our team, and he said, we need to establish a coaching program. And actually, what he would say, he would modestly say it was actually the advisors that we were working with who said we needed to do this because, it's difficult to change. We all know that. We've all tried to change things in our lives, and it's hard, and we understand that. And so we started the coaching program, which was really training and then coaching. So it's training in the practical application of behavioral finance, because we've all seen a million presentations on behavioral finance, and it's kind of, as we refer to it, as the behavioral finance entertainment complex.
Right.
And it's all very funny. And oh yeah, I do that dumb thing, and you leave feeling great. But what do? You go back to not using the tools and the information that we gave you because life carries on, and well, that'd be hard, wouldn't it?
Right.
So in the coaching, that's, and a lot of advisors that we work with, they talk about how well they do at educating their clients. And there's a really big difference between education and coaching. And I think that difference is important. So education, as when I was a child, I went to school and I was fed a bunch of information that I then had to regurgitate back at the end of the week in the form of a quiz, and then I promptly forgot it all. We all had to get our series whatever licenses. So we took in a bunch of information, took a test, forgot most of it, don't use most of it. But those pieces that we use, we retain, right? Yep. So my son, who's 10 now, his school is much more dialectic. It is team-based, it's experiential. It's all those sort of buzzwords, right?
Right.
But as a result, they, I believe, will have a better chance of remembering these things because they are involved in them. And so the coaching, when you think of an athletic coach, they're giving you skills and tips, active tips along the way. Okay, well, let's adjust this. Or, I think you could do this better if you use this tool to do it.
Right. Mm-hmm.
So it's active engagement in a process, which is much more useful when trying to make a change.
So the coaching, I mean, it's interesting, at the Institute, I've been involved with the Retirement Management Advisor Program since its founding, really, over 10 years ago. And it speaks to this notion of we've educated them on this process, but oftentimes they say, well, now how do I implement it? And it probably could benefit from some coaching.
Yeah, it's difficult to make a change. I mean, there's something called the trans-theoretical model of behavioral change, which is a mouthful, but it's a sort of widely accepted process of change in psychology. And it starts with pre-contemplation, where you're just not even thinking about something. And then, or maybe an active denial of it, right? Behavioral finance, that's for hippies, yuck. I'm a numbers guy. And then there's contemplation. Well, yeah, I guess I did have a couple of clients who acted irrationally back in March when the market was bottoming. And then preparation, like, okay, I'm gonna learn about this and I'm going to implement a system maybe. And so you start looking around for something that's implementable, right? You don't have to discover it and create it yourself. And then there's the action phase where you are doing it. And then there's maintenance. You've been doing it. You're maybe a part of a community that's doing it. You read about it. It's just part of what you do. However, at any point in this process, you can just drop out. So it takes intentionality to make a change, and it takes intentionality and commitment to maintain the change once you've made it. And I love the idea of a sort of proof of growth is if you look back on yourself with embarrassment, or look back on something you've done and you're embarrassed about it. And sort of, all right, I've grown because that me was kind of a ding dong, right?
Right. So
I think that's the technical term, yes.
So I guess among the things that you've been trying to do, you described something referred to as an emotional bell curve. Can you talk a little bit about that?
Yeah, sure. We did a study with the IWI a few months ago. And in that study, it showed, which may seem obvious, but people don't treat it as obvious, which is that people are willing to sacrifice some of the upside for not participating in as much of the downside.
Mm-hmm.
Seems sort of obvious, right? And so that bell curve of performance, if you shift that slightly to the left and cut off the left tail, so you never get into that super negative territory, that's generally what people want. Now, if you take that and apply it to emotions, right? You maybe, if you've got meh right in the middle, right? It's just like, whatever. Then you've got happy, and then further out, you've got ecstatic on the right side of the bell curve, or the right tail. And then on the left side, you've got bummed, and then the extreme is devastated. And in general, you're sort of in the meh to happy zone. Well, if you shift that just a hair towards meh, but cut it off at bummed, so you never hit devastated, that is what people are looking for emotionally, I believe. And also the ecstatic, maybe you never hit ecstatic, but ecstatic, that is more associated with like a gambling win, right? And do you really want your clients to be ecstatic with their portfolios? Because that's going to lead to expectations and maybe a set of emotions that are hard to control if they are ranging between ecstatic and devastated. That's a really wide range, and they require different sets of skills to deal with. And maybe it's better just to not have them ever hit devastated and maybe just go shy of ecstatic and have them in that just sort of like, it's fine. I don't, my portfolio just goes. I don't think about it that much, sort of treating boredom as an objective with your clients. Like being bored with your portfolio, like that's pretty good. Like your portfolio never freaks you out and it never just feels like the most amazing thing in the world. It's just something that's humming in the background that is getting you towards your objectives in the future. And your advisor is working on maintaining that. And they're doing the right thing because that sort of, low digit return and never getting creamed allows for pretty good compounding and, less stress in one's life.
There are, if memory serves, some mutual fund companies that I won't name that have made a habit out of being boring, or at least trying.
Yeah, I mean, there's different kinds of boring, right? Every plan and portfolio you put together is going to present behavioral challenges. It's just there's no way for it not to, right? If you go to the index portfolio, well, every once in a while, March, it's going to get crushed. And right now we may be in a state of reprieve, but and I call it a reprieve, not a relief. It feels momentary to me when you've got unemployment as bad as it is, with potential for further unemployment as businesses kind of half open up and schools are, many schools are leaning towards not opening again. The ripples of that, of all the suppliers, there's so many things, so many industries that are affected by this. And when you think about, the obvious one, the restaurant industry, right? That's always been talked about, but that employs 15 times the number of individuals as the airline industry. And they run, week to week at best. So the idea that every portfolio is going to present behavioral challenges is really important. So that index one, the challenge of the devastating market. If what you do is what we call a behavioral portfolio design, is you're stress testing for behavior and performance. So keeping it in line with what I was talking about, shifting the bell curve just a little to the left, but cutting off that left tail significantly, so that you have overt risk management in a portfolio. You have pieces in there that are designed to prosper in crisis markets, right? When we think about markets, we think of good markets and bad markets. Well, a Phillips head screw is not a bad screw if all you have is a flathead screwdriver. It's just not the right tool, right? So there are different markets and there are different tools to use in those markets. So the behavioral portfolio design is aimed at limiting the risk on the downside, which does cap the upside a little bit, but not that much from the research that we've done in the portfolios that we run with our clients, advisors rather. So what you find there is the behavioral challenge may be, well, I'm not getting all the upside, right? And that has been drilled into people's heads that the S&P is the ultimate goal. For most people, if they are achieving the S&P, they're in a portfolio that is irresponsible to their financial needs and behavioral needs, that balance. right? It's setting yourself up for failure to compare your portfolio, a client's portfolio, to the S&P on a regular basis. However, that is what most people do. And it's unfortunate because it's setting them up for disappointment at every quarterly or semi-annual meeting where the client's
Right.
portfolio did not meet the S&P. So, there are ways to look at it. If you can show them multiple factors, right? Let's look at your annualized performance number versus last year and the S&P and a blended benchmark. Well, now you're talking about looking at 4 things at once, and it's a lot harder to just say, yeah, but I wanted that one, because you've got all these things and they're all relevant.
So, do you want to return to coaching for a second and talk a little bit more about the skills versus knowledge transfer and the difference there, and the tools required to change and succeed, and also this notion of proactive coaching combined with just-in-time education, which is a phrase that I absolutely love. I know it all too well. Just-in-time education.
Yeah, I think the proactive nature of coaching. So all of us could use help at everything we do, right? And I think younger people are better at acknowledging that. And whenever they need to figure out how to do something, they just go on YouTube and they figure it out, right? They have this sort of, they're better at figuring that stuff out than older people. And to acknowledge that one needs help in what they're doing in an industry where it's a lot of lone wolves, for lack of a better term. A lot of people just work on their own, maybe with an assistant. They have a compliance department that makes sure they're not doing anything terrible, but really it's just them on their own with their own process. And that's not to say that it's the best process or the worst, but we could all improve. And so having a coach that will maybe look at what you're doing, point out some problems, tear apart what you're doing and make you justify it, right? Why is it this way? Why do you think this is the best? And maybe it is the best, but you need to justify it to me. And you need to justify every part of it, because you've got your practice, you've got your plans, and you've got your portfolios, right? A nice little alliteration there. For each of those, the behavior within those is important. And all of those can always be improved. So the concept of Kaizen, which is constant improvement, comes into play there. So the proactive coaching, working with a coach who's going to help you to better your process and your practice and your plans and your portfolios to accommodate for our behavioral needs as well, and the balance with that and financial needs. So when we work with advisors, we talk a lot about getting in front of people when they're calm to talk about things that are maybe stressful or that are stressful. So we have a process, a systematic process, where we look at behavioral challenges. And there are several obvious behavioral challenges: significant declines, flat markets, rising interest rates, et cetera. Maybe your local area has, maybe you only work with doctors and there's challenges there. But if you can apply a process to each behavioral challenge, it becomes a system, right? And especially with Reg BI right now, where they want you to be able to justify your process and have a demonstrable system, that's going to be really important for everybody to be able to do. And I would say that of the around about 150 people we've coached, very few people have been able to demonstrate their process. And that's a little scary.
That's surprising, extremely surprising.
They can tell me what their process is, but can they demonstrate it? They can say, oh, well, I'm a holistic advisor that, does this, but is it stated anywhere? In anything other than a marketing document? Usually not. And a marketing document is for marketing. It's not for in-depth explanation of what the process actually is. And people want to be included in the process. They want to understand, for the most part. I mean, some people are just delegators and don't. But to have people have emotional buy-in as well as the financial buy-in gives their plan a better chance of success, because they're invested in that plan succeeding.
Yeah. Do you mind drilling down a little bit more on that? Because when I think about what kind of process they need to document, what would you recommend in terms to comply with Reg BI?
Well, I mean, one of the things that we look at is the challenges that your clients are going to face, and how are you going to take them through those challenges?
Yeah.
And so sort of stepping back to the proactive nature of coaching and coaching clients, discussing with your clients in advance, all right, here are some of the challenges we're going to face. So, we're acknowledging the uncertainty, but really also understanding that things are going to be okay, right? You're going to be okay in the long run. So let's look at a behavioral challenge, significant declines, right? Then you discuss with your client, all right, here's the construction of the portfolio. This piece of the portfolio is designed for the significant decline, right? Discuss all the players and their jobs, and do this in story form, of course. Don't go into options. Nobody cares.
Right.
So discuss the team, right? What everybody's job is. Then you're going to go through a little process to address the instinctive, emotional, and logical. So first, instinctive. We all have, it's a significant decline. We all have an instinctive response to that, which, we've sort of narrowed them down to fight, flight, or freeze. Now, fighting that is not great because they're going to want the client may want you to change things in the portfolios that have a specific job that maybe is not happening right there, right? Like their index product. Well, maybe that's getting crushed at the moment, but that's the one that's going to come back the strongest when, markets rise again. So reframing that challenge, that instinctive response, retraining the brain, right? The military does a very good job of this. They put people in stressful situations and have them do tasks that would be difficult in normal circumstances, but they exhaust them, they scare them. All these things, we're not saying that you should terrify your clients, but in a moment of calm, you want to talk about these challenges. And this is how one is likely to experience this. Here's another way of looking at it, which is as an opportunity. Mm-hmm. So going forward, when we have a decline, we're going to think of that as an opportunity. Then get to the emotional response. There's the emotional response to that instinct, which is a combination of action and prediction. We want to take an action to ease that discomfort. It's March 23rd, it's the bottom of the market of this year. It feels terrible. We want to take an action to alleviate that pain. But in order to take that action, you are, in essence, predicting. You're predicting that this pain is going to go on for a long time. You're predicting that the thing that you want to do will ease that pain and be a better investment in the long term. Now, as we know from this long world of finance, that predicting is, we're not great at it. Right. We're not great at it. I don't think pandemic was really on that many people's mind earlier this year. We know that significant declines are going to come, but they generally don't project themselves as clearly as we would like them to. So then you externalize that temptation. So that emotional temptation, it's normal to want to take action and get out of here. So you externalize it and you normalize it. It's normal for people to feel this way. That way you're not saying you shouldn't do this because it's the wrong idea. Normalize, externalize. It's okay. Right. At that point, then they may be ready to get to the logical, the data, right? Most people, I'm sure that you can point to a couple, but most people don't want to go right to the spreadsheet, right? Right. They need to be gently eased into that data. And that's appealing to the logical brain. But really to get through the instinctive and the emotional, then people might be a little more open to hearing facts. And then after they've heard the history behind this challenge, significant declines usually are followed by big bounces in the market. All right, we've borne that out several times now, right? The last step is the pre-commitments. All right, when we have a significant decline, Mr. and Mrs. Client, you have an obligation and I have an obligation, which may seem weird that they have an obligation more than paying you, right? Mm-hmm. But in every relationship, there are obligations on both sides. And their obligation in that case is to not freak out and see the opportunity, see the potential for an opportunity, and to be patient. Right. It's uncomfortable, but patience is very difficult, especially when one is scared. And then the advisor's obligation is to rebalance into that thing that the person wanted to sell, probably, right? The thing that just got hit that is now on sale. Now, there's more to it than that in terms of looking at where the sales are, but to simplify a process of addressing challenges, this is also a means of differentiation, which I think is really important. So it is a very different approach than most people take in bringing people into their process and having them be able to feel it. And then that leads into the just-in-time education, right? This is the proactive. You're calm and they're calm when you're talking about this. This is not to get someone off the ledge. This is to keep them from getting to the ledge in the first place.
Right.
And then the just-in-time education has to be a refresher of this and then applied to the specific circumstances at hand and what their particular objectives are. So this is all familiar to them already. And I hear a lot of people say, well, I'm great at setting expectations, which is one of those things that kind of drives me nuts, because expectations can be introduced, but you can't set them, right? To me, that means, concrete sets, right? That's set. But an expectation can be introduced, and then the communication on a regular basis needs to be to maintain that expectation.
I don't think we talked about some of the workshops that you're running. Do you want to talk a little bit about that?
Sure. So these are the, umpteenth generation of what Phil Toews and I started 10 years ago, where the Behavioral Investing Institute, which is what came out of all of this, we were running this as a sort of little part of Toews, and then we launched the Behavioral Investing Institute to do the coaching, the workshops, and the keynote speaking as a separate business, because it got kind of weird when a competitor or another firm was hiring us to teach their advisors. So there are different forms. We do a lot of addressing at conferences, which are it's interesting now to have to reimagine what a conference is, because mostly what people are doing is just running a conference digitally. It's the same format. It's, here's an hour presentation, another hour presentation, a 15-minute break. And, that is not going to work. It's a different world now.
Right.
And we have to really adapt to that and make the changes that need to be enacted so that one can sit through maybe an entire day, or, some conferences are more than one day, but be able to retain and process information in a useful way. So we do the traditional presentations on specific topics around the practical application of behavioral finance, but then we also run workshops where we get groups of advisors together on curated topics. And so they're sharing their collective wisdom about a particularly challenging topic at the moment. What would be, right now. Okay, so as I was saying, I feel like, we're in this moment where the stock market and the economy are not in line, and there is of course a solid chance that we hit some lows after what we've experienced. And so how do we talk about that in a behavioral finance setting with a group of people? Well, that would be one topic we would talk about, and each of them would sort of share their experience and how they're preparing for the potential of another leg down in the markets, or further unemployment, or people retiring early. All of these things need to be thought out in advance so that you can have the discussions when people are in a relative state of calm, so that you're not trying to talk them into something when they're stressed. It's having a conversation with your teenager when the emotions are high. It doesn't work, right?
Right.
Let it simmer, have the conversation in advance, leave that emotional high for a moment and then discuss it again. But it's something that we really believe in, the sharing of knowledge. And it's something that doesn't happen as much as I would like to outside of a conference format, where it's a little more of the education than coaching.
Yeah. I don't think we talked about the segmentation of a book based on psychometric profiling.
Yes. So I was having a conversation this morning with someone that Dan Coleman and I were coaching, and the psychometric profiling is a really unfortunate title. It starts out with the word psycho. And so we're trying to come up with a new name for psychometric profiling, because it really sounds pretty aggressive. Like, I'm profiling you and I'm, probing deep into your brain to see, what cobwebs and dirt lies in there.
Yeah.
It's not very nice. But what we want to be able to do is to, most people segment their book into this sort of ABC clients, and it's usually the A's have a lot of money, and the C's are they're fine, or they don't have that much money, and maybe the B's they're some combination. Well, they spread my name around. That's good, or maybe some of the A's as well. But another way of segmenting your book is by the way people behave and the way that they like to be or they need to be communicated with. So if you look at if you just sort of picked a few categories for your clients: delegators, nervous Nellies, engineers, pain in the butts, and you segmented your book into those, let's say those four, just for the sake of the discussion right now, and you had a different means of communication for each of them. So, your engineers, they want to know the technical information about what's going on. But maybe your delegator or your nervous Nelly, that's either going to upset them or they're just not even going to look at it because that's not for me and it makes me feel stupid.
Right.
That's an emotion that people have. And it's kind of like having the Wall Street Journal in your office. Like it can make people feel insecure. Mm-hmm. Have books on the hobbies that you like and your clients like. Right. It calms people down.
Right.
But changing the way that you communicate, and now, all this stuff is so easy with technology. And if you feel intimidated by the technology, ask your niece. She's not intimidated by it.
Right.
Like she'll be able to come in and look at your CRM and be like, yeah. You just break them up like this, and then
as long as I don't have to make a TikTok video, I'll be okay.
Right. You leave that to her. You're good.
Yeah.
And I think, actually that brings me to an important point of we're in an old industry. We are old people in this industry for the most part, and it's a slow industry to change because we are old, because of regulation. But it's important to have young people in your book. And the reason for that is what they want now, the rest of your clients are going to want in a few years. So you might as well start learning now so you can adapt early. And those people are going to have money someday. And, I don't want to waste my time with young people. Why don't you learn from them instead? Because they do have a lot to offer if you listen.
I have a house full of young people, so I know that lesson. So I don't think we've discussed something called the red team. Do you want to chat about that?
Yes. So red teaming is something that started out in the government and quickly moved into security in terms of hacking. But red teaming is having someone come in or a group of people come in and poke holes in what you're doing. So on the cybersecurity side, they try and hack your system. Mm-hmm. But what we talk about in the coaching program is we want to red team your process. We want to red team your practice, and we want to red team your portfolios. So we're looking for first of all, we want you to justify all of them to us. Why is it this way? Why do you do it that way? Just so to improve your communication skills around it, first of all, and then you may start talking about it and realize, well, maybe that isn't the best way. But we want to challenge you to do things better. And so those people that enter into coaching, those people that are probably listening to this podcast are those that are interested in education, those people that have gotten the designations and are members of the IWI because they are people who seek improvement, right? Mm-hmm. And that's what red teaming is about. It's about looking at the problem areas and then developing systems for correcting or improving them. And it's something that we could, as I was saying earlier, the coaching is something that we could all use in all parts of our life. Mm-hmm. And I think that that's what therapists are for, right? Like that's why people get life coaches. And this is a business coach, essentially, someone to come in and look at your practice, the way you communicate with your clients. 72% of clients leave because of bad communication. And that doesn't mean because you didn't send them a monthly email. It means because you were sending them the wrong stuff.
Right.
Or communicating with them in a way that they didn't appreciate or felt that you didn't understand who they were, who they are. So I think that...
Yeah, I was just going to say that years ago, I worked at Dalbar, and we had done research around that very topic about why clients left their advisors. And much of it had to do with the issue of communication and poor communication or not timely communication.
Yeah. I mean, it's fascinating, and it's sad that something, that simple as, segmenting your book to communicate with people properly, or the language that you use. When I hear people talk about a strategy underperforming, I want them to like put the words back in their mouths. Because if you have something that is literally underperforming, why is it in the portfolio?
Yeah.
Why is it there? And the way I think that people could use better words is to say it's out of favor right now.
Right.
Right. If you have a truly diversified portfolio, there should be things out of favor, right?
Right.
There should be things that are not performing optimally at all times, because cyclically they will. And when you say, oh, this strategy is out of favor right now because it is our defense or it is our offense, it gives them the really easy mental leap that this is cyclical and that is designed to move at a different time. So it makes it easier for your communication and for their adoption rather.
It's also interesting with respect to underperformance and client communication. I was speaking to an advisor the other day who said that one of the hardest things that they've had to do in their office is to train their young advisors to actually make the outbound calls to talk about the client's portfolios, even when they're right, especially when they're maybe out of favor, or things might be out of favor. She said that was hard to get young advisors to learn that it's okay to talk to people about things when they're out of favor.
More than okay, essential. I mean, that's when clients change hands, right? Is when things are bad and you've risen to the occasion or you haven't. And one of the challenges that younger people are going to face working with older clients is when I'm 48, and when I make a phone call to a friend, it feels radical as opposed to sending them a text. It feels invasive, right? And that is sort of the norm with younger people. Whereas I grew up, as a teenager, spending an hour and a half every night yakking on the phone with my friends. So there is a part of me that feels very natural being on the phone. And to call people in times of stress and to remind them of the conversations you've had and why things are going to be okay and your responsibilities at that time and how the portfolio is designed to deal with it and normalize their feelings. Man, sometimes people just need to hear that. They just need to vocalize that they're scared, or to have you in turn just say, this is a scary time. I'm a little scared too, but we've got a system in place that we're not going to deviate from because it's designed for times like this too.
And that's been the case with many of the advisors that I've spoken to as part of the Exceptional Advisor in Extraordinary Times series, time and time again. The call being made was to someone to say, "Remember how we put in place this plan, and for times like these, and it's performing exactly as we expected it to, or wanted it to." So, and that call was enough, for some.
Mm-hmm. Yeah, I mean, everyone has a breaking point, right? So our Toews strategies did exceptionally well in the crisis earlier this year, but a lot of other managers who had sort of touted risk management, they got creamed. And the idea of breaking points, we can all endure pain to a certain level, and then we just can't take it anymore. And I think that actually all of the declines that we've had since the Great Recession have bounced back so quickly that most people haven't hit their breaking point, and we've been given free money. We've been, reassured by the Fed that they're going to do everything they can to keep markets going. And so we've gotten kind of dull to the idea that really bad things do happen sometimes, and sometimes they last a long time. But those events seem to be outside of our recent memory and therefore feel like just stories from olden times.
Right.
Where it's, you don't really have an emotional internal connection to something unless you experienced it yourself. So, the recession of 73 and 74, well, nope, it's just a story to me. The Great Depression, nope, just a story to me. 1987, I have an emotional connection to that. Everything since then, I have an emotional connection to. However, the further in the past that they are, the less intense it is, right? So we're all preparing for 2008, or maybe up until February, and that wasn't what happened, right? We experienced something else. Now the outcome may be similar in that markets dropped, but they dropped so quickly that most people were, in some cases, just blindsided by it, and for many others, they were focused more on theirs and their loved ones' health. So there was something else they were looking at other than their portfolio value at the time, which actually worked in the favor of elongating that period before someone, cries uncle.
Right.
And then,
So you mentioned the phrase Kaizen a little bit ago, continuous improvement, and I'd like to return to that for a second. Two notes before we do. One is I'm reminded of how Ned Johnson, former head of Fidelity, often used that as his phrase at Fidelity, that the firm was dedicated to continuous improvement. Which leads me to a question about here at the Institute. Obviously, we offer the CIMA designation, the CPWA, and the RMA. Any thoughts about the degree to which that education plays in terms of continuous improvement and in the world that you reside in?
I mean, I think that I commend all of you for getting your designations and engaging in Kaizen, because that's what we all need to do to grow as humans. And we all, I would imagine that everyone on this listening to this podcast has dedicated themselves to a form of continuous growth. And the designations that you have open up a huge library of information to you from the IWI. And I think the coaching that we do and that others do is another door that can open for you to continue that growth and education, and from the psychological, relational, and financial health of your clients, and balancing all of that together.
Right. Okay. And then when we were chatting before this podcast, we talked a little bit about the CFP board and the 7 steps and how it's moved from 6 steps to 7 steps. Care to chat a little bit about that too, and your observation on that?
Yeah, I think it's fascinating. I mean, they were really, really boring, the 6 steps. I mean, I think the first one basically amounted to like get them to sign a contract. It was something as dry as establish relationship with client. It was just very, very dry, and it really, they were hard and essentially like you weren't dealing with people at all. And now they've added a step, and it's really softened to getting to understand and know the needs and objectives of your clients. And that is much more the focus now. And the CFP board is a slow ship to steer. And I am glad that they made that move and acknowledge that there are actually humans on the other side of these portfolios. And I think that concept of empathy is so important when designing a plan. The buy and hold index strategy, just tough it out, like you just got to get through it. Well, it doesn't really take into consideration that people have emotions. And, well, I told you markets were going to go down, and now they are, and you just got to tough it out. Well, that's like that, jerk football coach in high school who just told you to walk it off when you had a broken ankle, like that I don't think that works in today's world anymore. We have too much information at our fingertips to just walk it off. And if you can check your portfolio value from minute to minute, well, there's too much coming at you to just deal, which is what we've been told in the past.
You and I, before this call, we also talked a little bit about financial therapy and financial life coaching. Care to sort of?
Yeah. So I did the financial therapy program at Kansas State, which was great. And usually when I mention financial therapy, people giggle.
Right.
And it is kind of exactly, it's exactly what you think it is. It's, sit down on the couch and tell me about how your mother taught you about money. And looking into one's financial narratives about who they are and what is that based on, your parental lessons, And what did your grandparents do for a living? Where did they live? What was their experience like? My grandmother was born in 1920 and was a young person during the Depression, and she was a young mother during World War II. And this profoundly affected my mother, who is a very smart and frugal woman, which then in turn affected me. So looking through the lineage of how we got to be the way we are is very deep and important. And looking at the experiences that we've had, positive and negative, with money. And I don't mean from a dollar perspective, I mean from an emotional perspective. What is the impact at a young age of your first job, or your first house, or a gambling gone wrong, whatever it might be? The dollar amounts might not be significant, but understanding the emotional triggers within. And so we actually have a tool for looking at one's financial narrative and getting them to show you rather than tell you. Because everybody wants to present themselves as much as we don't think that we do. We want to present ourselves in a certain light. I know a couple. One, the man is very pragmatic and just sort of, this is the way things are. And the woman is very aspirational in terms of who she wants to be. And so they look at their finances and their interactions, their experience with money, in a very different way. Neither one of them is wrong. It's just different. And so having someone show you that rather than tell you, well, this is how I feel about money. Well, maybe you do, maybe you don't, but better to have it illustrated and to take it out of the verbal and into something physical, low tech, and tangible. Sometimes really gets people to change their thought mode.
You mentioned tools, and it struck me that we also talked about a decision-making tool that you have developed and gamified. Would you mind sharing a little bit about that?
Yeah, it used to be called the Decisionizer, which I liked much better than the name that we've come to, which is the Decision Matrix. But working in finance, it's important to make things boring. So the Decision Matrix, when we're contemplating a decision, there are so many factors that we have to think about. And you mentioned yourself, just writing all the different factors down in a spreadsheet and then ranking them, right? We're not good at doing this mentally, because the factors float around, and depending on which one is in front of you at the moment, you may value that one more highly. Oh, because I forgot about that one, right? But if this tool allows users to gamify a decision, you enter the decision, you list all the various factors, and then you rate them one by one using basically a slider. And at the end of that, it issues you a number, and is that number positive or negative? And what we've found is that the positive net number would suggest that you should do the thing, the negative, you shouldn't. And what we found is that people are sometimes surprised by the intensity of the answer, though rarely, in fact, actually never, have we had anyone say, I disagree. So sometimes people think, well, I thought it'd be more neutral, and it turns out to be a hard negative. And they say, oh, yeah, you're right, I don't want to do that. But I needed to lay it all out and look at it to really feel it and see all the factors and see, like, yeah, that's a bad idea. Whereas, them all swimming around in your head at once, it's too hard to quantify.
So we've covered a lot of ground. Is there anything that we haven't talked about that you'd like to mention, or anything that we've talked about that you'd like to reemphasize?
Well, I would love to talk all day because it's fun, but I'm sure everybody has their lives to get back to. I appreciate that the people that are listening are here to improve themselves, and that is an admirable quality. You're listening to learn, and that is to be respected and built upon. So, if you're interested in learning more about the Behavioral Investing Institute, Google it, it's there. And I'd be happy to talk to you about the tools that we have and our process, and why I think it's important to challenge the way you do what you're doing now. And I thank you very much for having me today.
Well, and thank you, Eben, for talking with us and sharing your knowledge about this really important topic. Much appreciated.
Thank you. Take care.
Thank you for listening to this episode of our special series, Exceptional Advisors in Extraordinary Times. My guest was Eben Burr, Managing Director of Toews Asset Management. If you've enjoyed this podcast, then don't miss our Exceptional Advisor webinar series hosted by Tony Davidow, available at investmentsandwealth.org. Stay up to date and have the latest episode delivered straight to you by subscribing through iTunes, Spotify, or wherever you get your podcasts. The Institute stands ready to help you as you navigate these turbulent times with new resources, research, programs, accommodations for candidates, and certificates. For more details on resources available, visit www.investmentsandwealth.org. The Institute is a professional association, advanced education provider, and standards body for financial advisors, investment consultants, financial planners, and wealth managers who embrace excellence and ethics. Through our events, continuing education courses, and acclaimed certifications, which include the Certified Investment Management Analyst, Certified Private Wealth Advisor, and Retirement Management Advisor certifications, we deliver Ivy League and practical education for investment and wealth professionals. The Investments and Wealth Institute has been helping investment and wealth professionals become exceptional advisors for over 30 years. Please visit us at our website, investmentsandwealth.org, to learn more about our certifications, conferences, online learning, and continuing education programs.